I think the membership model is the key differentiator there because you're right. They are known for like their huge TVs and they sell tires and they sell luxury goods like jewelry. They don't have a dividend. So again, this is probably one of the core things that I usually look for when I'm buying a consumer staple stock is I want companies that give me consistency. Yes, I mean, if you were to pick one stock on this list that's like, what's the one that'll let me sleep the best at night? It's probably P&G, just because they have the absolute best portfolio and positioning out of pretty much any company on this list.
Hey Alex, how you doing today?
Hey, James, doing great. How about yourself?
Doing great as well. You ready to talk stocks and more?
Yeah, I'm excited to get another tier list here kicked off.
Yeah, me too. So today, what do you have us running through?
So today we're going to be focusing on the sector for consumer defensive or consumer staples.
Okay, consumer staples. So I'm assuming things that people have to buy regularly. Why the defensive term?
Yeah, so think of these products as really, and retailers as really inelastic. So, regardless of how the economy is doing or where people's money is at, these are products or retailers that people feel like they have to go forward with. So, really consistent demand, which means that we're going to be seeing a lot of dividend plays here. So, if I'm investing in this sector, this is not necessarily a growth position for my portfolio. Now, there's a couple of names that we'll go through that actually are growing well, but in general, I'm looking for nice dividends, good dividend growth, and a safe play that helps balance out the rest of my portfolio.
And by safe and balance, what we mean is maybe part of your portfolio will be focused on companies that are growing and their stock price is growing up. These companies, their stock price doesn't go up as much, but they have steady revenue, income, a dividend, which means if the market fluctuates, these kind of hold the line within your portfolio. Is that how it works?
Yeah, that's exactly it. So if there's really big down days in the market, these stocks likely do not dip as hard.
Mm.
But on the flip side, if the market is running, these stocks probably are falling behind. So they really help balance out any of the high tech growth. Like if you were focusing AI, these will help give your portfolio more stability when things pull back.
So they're helpful to just let me ask you this. So when you're thinking about your broad general portfolio, how much of this category should be in your portfolio?
So I would say that it really depends on where you are in your investing journey. If you're a newer investor and kind of just getting started, I really would only pick maybe one or two of these companies to invest in.
Mm.
And again, maintaining that there's no one stock that I invest more than 20% of my money in. But if I'm a new investor, I would more lean into some of our other videos. And so I'd really recommend people subscribe to the channel so that you don't miss those other videos where we talk about more of the growth stocks. So if I'm a new investor, I want to lean into growth because I want to build my base and build my portfolio. If I'm more of a seasoned investor with more money, I could start adding multiple names from this list because it'll help guarantee some steady dividend income for me and also provide more stability after I've built my base. So that's kind of my feeling on how I would start thinking about this sector.
Right. And do you see when market fluctuates where maybe uh, something's causing volatility in the market that people move money or institutions move money from high growth to this and park it for a while?
Yeah, I mean, we're already starting to see a little bit of these rotations in the market right now. Whenever you see those really big down tech days, a lot of the names that we're going to be going through, their stocks are going to be going up because people are taking profits in tech and rotating it back to these stocks. The problem is, once tech starts taking off, you will see these start to dip a little bit because people will want to cut a little bit of this to make sure they don't fall too far behind in their portfolio. So, again, don't go crazy with any of the names in this list. These are just really good ones to help balance your portfolio out.
All right. Well, you ready to dive in?
Yeah, let's get right to it.
All right. The first one on the list is Target. Curious your thoughts about Target, maybe as a dividend provider, growth opportunity, how it handles or acts within the consumer defensive thinking. Thoughts on Target?
Yeah, so Target has a decent dividend. It's 3.2%. They have been able to grow it pretty well with double digits recently, so we like to see that. They kind of been pulling back recently, though they did pick up a little bit in the last quarter. So they have a little bit of growth moving forward. The thing with Target that I do not like about their model is that if I have a consumer defensive stock, I don't really want companies that sell too many luxury goods because luxury goods do not perform the same as the other companies that we're talking about on this list. So if I have a consumer defensive position, I want a company that sells consumer defensive products. And Target is weird because it kind of leans into furniture and clothes and some of those other big ticket items instead of consistent grocery. So that's the piece that I don't really like about Target very much.
Yeah, that's fair. Nate Bargatze's got a funny bit where he talks about like Kmart is like bottom of the barrel, Walmart's like middle, and Target's like, the more bougie of the lower end kind of type stores. But to your point, if they have luxury stuff and the market is bad or the economy is bad, they're going to feel some of that because people may prefer some of the more affordable consumer stores to go to.
Yeah, and to add on to that as well, Target's leadership is bad.
Mm.
They make so many poor decisions. One day they're leaning into Pride, the next day they're like, "Just kidding, we're canceling all of our Pride stuff." I don't like leadership that is really wishy-washy on the direction they want to take the company to. If you want to stick to things, stick to it and own that position. I think the leadership in general is really weak at Target, and that really starts impacting where I would have them on the list.
All right, so Target, what do you score?
Target would be C tier for me.
C
So
tier.
there's going to
Okay.
be a lot of other better companies for us to talk through.
Okay, so when you're thinking about investing in this sector, consumer defensive, they're not your top tier ones. All right.
Definitely not. No.
All right.
So they're a great example of a company that just because it's consumer defensive, it doesn't necessarily act like one.
That's fair. That's fair. All right. Next one is PepsiCo. What's your thoughts on Pepsi?
So we've talked about Pepsi in some other videos. So I recommend people
Mm.
also check out the dividend tier list video. But Pepsi is a overall good company because beverages in general are kind of outperforming other categories. So the fact that they play a major role within the beverage sector is a huge positive. And what's crazy with Pepsi, kind of like some other names on this list, they own so many brands in the beverage aisle that most people have no idea that they own. So they obviously soda is the big thing, but they have all kinds of water and teas and energy drinks, all that stuff falls under there. So that it's nice that they're playing across all of those different segments within beverage. The other thing that a lot of people may not know is that they have a salty snacks business and that they own Frito-Lay. So they're kind of playing in these two different areas. But what's happening with them right now is they've got a couple of headwinds going on. You've got sugar and high sugar. So you're seeing a rotation now from full sugar sodas to this zero sugar, which is doing overall pretty well for them. But then you've got salty snacks and GLP-1s that people are taking, and I'm not snacking as much as I used to. So their salty snack side of the business is really getting impacted. So that starts kind of impacting my thinking on the company.
Yeah, so obviously you were investing in COVID. We had talked about that in some of our early videos. When the economy is doing bad or something big like COVID is happening globally, do consumer defensive stocks grow and gain? And did PepsiCo do well? Were people buying more drinks and snacks?
Yeah, I mean, when a kind of catastrophe happens, like what we saw with COVID, these are the stocks that do well during those
Okay.
moments because
Yeah.
people want to run to safety. And, if I think the world is ending, I no longer care about my sugar intake. Like I'm going to go drink my soda and I'm going to eat my snacks. So if there are bad times where things like that happen, that's where companies like a Pepsi did get a bump and actually did pretty well. But now we're kind of coming back to more of a more growth environment. we're getting some more details around the peace deal. And so maybe war might be subsiding as well. So that's where people start thinking more, do I need more growth in my portfolio rather than consumer staples?
And is the whole GLP-1 thing actually impacting this space in the industry with sugar drinks?
Oh, definitely so. And I mean, when you look at the key drivers across a lot of the soda brands, the full sugar ones are going to be declining while the zero sugar is the big uptrend.
Mhm.
So that's a huge focus area, as well as artificial colors. That's another thing that is starting to really impact a lot of these trends, especially on the snacking side of
Mhm.
the business. Like if I go buy my flaming hot Cheetos, like that red color is not natural. Believe it or
Right.
not, that's not naturally occurring. So those are kind of in the spotlight right now. So those are a couple of headwinds that are going on that they have to adjust to. So that kind of brings their growth ceiling on the future down a little bit, in my view.
Yeah, that's very insightful. All right, so PepsiCo, what do you score it?
Pepsi would be B tier. So I think this is a company that you can go with because they are diversified, but just know that their high level ceiling may be limited because of that too.
Mm, that's fair. All right, next one is Clorox.
Yeah, I think Clorox is probably, let's say, the most boring name that we're going to talk through today. They have a fantastic dividend. I
Mm,
mean, almost 5.2%, but it hasn't really been growing. And that's because the company's earnings have not been really growing. So, what you're buying here is basically like the ultimate safety stock, if you will. They have really well known brands. And talk about a stock that killed it during the pandemic. Clorox was it because, we wanted to clean everything. So, Clorox stock did amazing during the pandemic because, I mean, you couldn't keep it on the shelves. Everybody was wanting to wipe and clean everything off. So that was the perfect example of what a stock like this can do during a moment of crisis like that.
yeah, and it's got a decent dividend. How does it compare against some of the other stocks in this sector?
Yeah, I mean, it's definitely on the high end of the dividends that we're going to be talking through
Hmm.
today. And I think this is a really good example, though, of if I own Clorox, I'm basically only getting the money from the dividend. Like
Right.
the underlying stock is probably going to be flat to down.
Mm,
So it might even get to the point where the stock is pulling back and offsetting the dividend. So that's the main part of Clorox that I don't like is that there's high risk of that stock going down. So I'm going to be lagging the market most likely in Clorox.
all right. Well, drum roll. What do you score Clorox?
So Clorox is D tier. So
Mm,
I would avoid, especially compared to a lot of the names we're going to go through.
mainly because of what you just mentioned.
Yeah, I don't want to own stocks that have a high chance of declining and having that really high dividend not make up the difference. There's
Mm.
better names.
I'd be interested to see if any government officials right before COVID went live bought Clorox.
I mean, let's be honest, it probably happened.
Yeah. Yeah.
Yeah.
All right. So that's Clorox. The next one talking about is Monster Beverage, the energy drink.
Yeah, so this one is a kind of a different one versus the rest of the list.
Right.
They don't have a dividend. So again, this is probably one of the core things that I usually look for when
Mm,
I'm buying a consumer staple stock is I want companies that give me consistency. Monster doesn't bring that, but Monster is playing in energy drinks, which is, have been a consistent double digit growth category. So they are perfectly positioned on the type of product that they're making. So they have more of a growth ceiling versus a lot of the other companies that we're going to be talking about. So they're kind of the wild card on
mm.
this list. Do I want to put a position like Monster in my portfolio that's supposed to be my safe position? That's the question you need to ask yourself.
Right. Right. And I imagine that whole space that they're in with energy drinks is highly competitive. Do they have any form of moat or, differentiator that keeps them at, the top of their industry?
They have huge competition. I
Mm,
mean, they've got Red Bull as the number one player there. And I mean, that's a private company that you don't get a full glimpse into everything that they're doing. They have upstarts like Celsius and Alani Nu. There's tons of competition because there's so many products that want a piece of the energy drink pie. They have great brand recognition.
Hmm.
They are also distributed by Coca-Cola. So they have an amazing distribution network. So they have some advantages going for them, but you just have to think about like it's not that hard to make sugar water and add some caffeine to it. It's all about the branding and the positioning, which they do have a good position.
Yeah, and their PE though is a little scary. It seems a little highly value inflated.
Yes, it's up there.
Yeah, maybe just because of the brand and the excitement, kind of driven the stock price up.
Yeah, I mean, it is rare to find a growth company that is a CPG beverage company. Like that's not normal, right? Like
Right.
it's like wow, they really have a lot of really good future potential, and they're one of the double digit growth projectors that we have on the list today.
Mm. All right. Well, so drum roll again. Monster Beverage. What do you score it?
Monster is B tier,
Okay.
so the growth is amazing, but if I am picking a consumer staple company, I would rather be in one of the safer names on the list.
During COVID, did the popularity of energy drinks wane?
No, I think it picked up
Oh, it
quite a
did.
bit. I mean,
Okay.
everybody is tired, worrying, and that's where we really started seeing people start storing energy drinks at home.
Mm.
So there was actually really big demand, and I think that that's pretty much continued. I mean, the energy drinks category has slowed a little bit, but in general has been a very high growth category in the store.
Next one is Kroger.
Yeah, so everybody should know Kroger. This is the first kind of retailer in the grocery space that we are talking about, and big news was, the Kroger Albertsons merger.
Hmm.
That was the big thing that we heard recently talked about, and the government kind of broke that up. I was really surprised by that because, in my opinion, it was a win-win for both companies. Grocery has extremely low margins.
Mm.
So they are really not making much money when they sell you things in the store. And talk about highly competitive. I mean, there's tons of players within that space. And not only are you competing against other grocers, you're also competing against your Walmarts and your Costco's and your Targets. So there's a lot of competition in that space. Kroger also has a decent dividend. It's on the lower end for the list. It's just over 2%, but they have been growing it by double digits. So I do like that piece quite a bit. But again, it's grocery. So like their growth prospects for the future are pretty low.
Yeah, and I was surprised to see Kroger with such a high PE ratio of 45 or something like that.
Yeah, I feel like what happens with that is they can really start investing in and out of the business depending on the time of year
Mm.
it is. So when we look at their forward PE, it's down under a 12. So
Oh,
you can see it's dramatically lower as we look into that.
I
So
see.
this one's kind of an interesting dynamic there when you see that.
Okay. Okay. Grocery store, Kroger. What do you score it?
Kroger is C tier.
Oh,
So I really don't like the growth ceiling. Grocery is way too competitive for me. And if you like the nice double digit growth and the dividend, I guess it's fine. But I think there's other names on the list I'd rather have you in.
that's fair. That's fair. That's fair. All right. Next one, Coca-Cola. Thoughts about this? We talked about PepsiCo already.
We did. And this is another one that we talked about in the dividend tier list one.
That's right.
Coke has probably the most recognizable brand on the planet. It's right up there with Apple. They have very consistent demand for their product, and Coke Zero Sugar has been one of the highest growth beverages that's within the category. They have a really good dividend. It's 2.6%. They haven't been growing it as fast as some of the other names on the list. So it'd be nice if they were growing it more near double digits. But they have just, everybody wants their Coke. And, you know, when you have a name that is so synonymous as a Coke product is, you just can guarantee that they're going to be able to have a really strong brand presence moving forward.
All right. Well, it sounds like Coca-Cola may be higher in your tier ranking. What do you score Coca-Cola?
Coca-Cola is A tier.
Mm,
And again, I'm willing to pay up and get a lower dividend because the brand is so premium. And I know that they have an amazing distribution network and it's a brand that I can count on.
Right. And you mentioned one of the key things happening in market with the GLP-1s, but they have the zero sugar version and that's performing well. So maybe they're figuring out a path.
That's right, and they play in so many different segments within beverage. I mean, they own a huge portion of Monster because they distribute them. They're just really well diversified, and it's just a really good company.
That's great. All right. Next one, Altria.
Altria is an interesting one. So we're starting to pivot to what's a funny, interesting thing to think about is tobacco. And, we're talking about consumer staples. And, sadly enough, tobacco is a staple in a
Mhm.
lot of people's lives. We have not seen it continue to have growth. It's like a declining category, but there's still tons of people that use their products. Altria has the highest dividend that we're going to talk through today. It's over 6%, which is pretty incredible.
Wow.
And they've been growing it in the low single digits. So it may even move up. The thing with Altria is they are playing in a declining category, a massive category, but they are playing in a declining one. And they haven't made too many moves yet to get away from the tobacco into more of a smoke free environment. So my future growth prospects for the company are low, and that's why they have to pay such a massive dividend there.
So with the low PE ratio and the high dividend, what score do you give it?
I give Altria a C tier.
Okay.
So again, they have a great dividend, but the underlying stock is at risk to go flat or down, and those are not the kind of dividend companies that I like.
Right. Unless they come up with something super innovative, they're on a sinking ship, if you will.
Essentially, yes. Yeah, and it's going to cost a lot of money to pivot.
All right. Next one, thoughts about Hershey.
Hershey is another brand that everybody should know. Very big chocolate company. They have multiple brands that kind of fall under that umbrella. What's interesting with them is that they're a little bit of a more of a luxury good, if you think about it, than some of the other brands that we're talking about. They have a good dividend. It's right around 3.2%, and they've been growing that in the double digits as well. So those are both like big check boxes for me. The other thing that's great with them is that they are one of the highest growth companies on this list. Like they're really expected to grow their EPS in
Mm.
the future, nearly 20%. So all of those are really, really good things that are going for Hershey in general. So you're probably wondering, okay, well, what is the catch there? And the big catch is their inputs, their the price that they need to pay for their goods, and cocoa is the main thing. Cocoa has gotten extremely expensive over time. And with global warming and environment changing, it's super at risk for anything bad to happen, and it can be damaged really easily, and the cost can continue to go up. So the concerns come from their margins moving forward.
Yeah, and I only anecdotally have read or heard this that they're trying to work on their formula for that chocolate to have less cocoa and supplement it with artificial flavors and things to where I've seen complaints online of people saying the old Hershey's chocolate tastes way better than this new chocolate. I don't know how true that is, but I see them probably trying to optimize their cost of goods, but yet maybe messing with the formula a little bit too much. It'll be interesting to see how all that plays out.
Yeah, and I mean, if you start losing your core consumer and they pivot to something else, you're in big trouble. And I don't remember, do you remember when Coke tried to make new Coke and
Hmm.
it flopped and they had to go running back to the original formula? So what if Hershey has a similar
Right.
event happen where they're probably doing the right things, trying to look for better ways to cut their costs, but are you cutting it at the wrong spot that hurts the consumer? That's the big question.
Right. It's fair. All right. What do you score Hershey?
Hershey is B tier. They would definitely be higher on the list if it wasn't for the cost of goods issue. But you are going to have to just, if I invest in Hershey, I know that that's going to be a problem moving forward.
By the way, I did also get to visit the factory and campus in Hershey, Pennsylvania.
Mm.
Randomly, that was kind of a cool little treat. All right, well, that's Hershey. Next one, Kimberly Clark. Thoughts about Kimberly Clark?
Yeah, I think this is another one that you could kind of put in that boring category of, baby products, paper products, not the most fun things, but if people need them, they need them. When I think of like when a disaster happens, when bad weather happens, Kimberly-Clark's products are the things that get bought off the shelves first. People need that toilet paper.
Hey, you never know when there's going to be a run on the toilet paper. Those
That's
were wild times.
That's right. So you never know. But then you can also have fires at your plant, and then you lose tons of product. That was a really big story that happened where
Hmm.
the worker actually set fire to one of their plants. And so I haven't gotten any more updates after that, but that is definitely not good for production. But anyways, they have really strong dividend. It's just north of 5%. It has not been growing very much. It's been in the low single digits, and their future growth prospects are pretty limited as well. So this is another one where you're kind of buying the safety of the categories they play in instead of the growth prospects of the company.
That's fair. That's fair. And I imagine anyone trying to diversify your and or defend, you probably have a breakout of bonds, other defensible stocks, some ETFs, just to kind of round out that defensive side of your portfolio as well. Thoughts there?
Yeah, I mean that's where the question comes in of, do I pick an individual stock like this that has pretty limited growth, or do I find a better way to protect my portfolio?
Fair. All right, Kimberly-Clark, how do you score the company?
They are C tier.
Mm.
So again, they have a strong dividend, but when these companies have a chance of me declining within the stock while waiting for the dividend, those are not companies I really want to be in.
All right, next one, Mondelez.
Mondelez, so this is a snacking company
Mm.
that across the board. They have a decent dividend, 3.3%. They've been growing it really well, right around 10%. And because of that, they kind of trade at a pretty expensive multiple versus some of these companies. That right now they're trading around a 31x.
Mm.
So that's kind of expensive for a CPG company. They have almost double-digit growth projected moving forward, so that brings their forward PE to around an 18.6, but still kind of expensive versus only having around 8% growth. But they play in strong categories and they have really good brands, so it's a good company, and it's a little bit different than some of these other ones. It's like a blend of good dividend growth with decent company growth.
Mondelez, yeah, I haven't heard of them. What are some of their brands that I might recognize?
Yeah, they have big brands, and it's again, it's one of those companies that like it's like an umbrella name that owns a bunch of things that you haven't heard of. But Oreo and Ritz crackers and Swedish Fish, so they play in cookies, snacks, candy, kind of all those things that we all love and sometimes eat way too much of.
You had me at Oreos.
Yeah, there you go.
All right, so Mondelez, what do you score Mondelez?
Mondelez is B tier. So again, really good growth, good dividend. So it's a good name to be in. I have other ones that I like more, but this one I could see people going with.
All right, next one we alluded to or talked about the industry a little bit. Philip Morris, thoughts there?
Yeah, so this is the other major player within tobacco, and they're positioned a little bit differently. They also have a good dividend. It's right about 3.3%, but compared to Altria, that's about half if you think about that. Like their dividend is significantly lower. They've been also growing it a little bit slower, like right around 3%. So not great dividend growth actually from
Mm.
Philip Morris. But when you look at their forward growth, their growing growth prospects are right around 10%. So this is the interesting piece is that they have a massive tobacco business that's also international, but they are better positioned than Altria because they have a larger portfolio of smoke-free products. So the Zyn pouches and everything that where you're seeing a lot of people choose those instead, they are very well positioned there.
It's great. Philip Morris, made famous by the Marlboro Man. What do you
Yeah.
score?
They are A tier. So
Eight.
I
Okay.
they have very strong demand for their product. They have a good dividend with good growth and they're positioned really well. So they're a great dividend and defensive play for your portfolio.
Yeah, it's funny and with investing or any of this, A company like Philip Morris may be doing well from a financial investment perspective, but then, you also have to think about, is this the type of company I wanted to invest in? No judgment at all, but it's funny how companies, whether, for instance, like defense companies that do well during wartime or things like that, you have to ask those broad questions like, okay, they may be doing well now as an investment, but do I believe in this company? All those other questions that come up. It's just interesting as you see these different names.
It is interesting when you start blending like morality and ethics with making money because that's like they are two very separate things, but there are
Right.
people very passionate about a lot of these. So it's like I can completely understand why some people would just want to straight up avoid it because of that. And there's other names you can invest in. There's tons of companies out there.
Yeah, I mean, when you have controversial names like, Elon Musk and his companies, or Palantir and their war support and with the defense industry of military and things, it does create some dynamics.
It does. Yep. Like I said though, there's a million companies out there. So if you don't
Yes.
like them, just pick another one.
All right, the next one, a little bit safer on that accord, the toothpaste company, Colgate-Palmolive.
Yeah, doesn't that get you excited to
Mm,
invest? Like,
mm,
oh, I can't wait to invest in some toothpaste,
clean.
Uh, but you know what you need? You need toothpaste, and that's why it's on this list. So they have a lower end dividend, 2.4%, so still pretty good. They've had pretty limited growth in the dividend, which I don't like very much, and really expensive from a PE ratio. They are almost a 35 for
Mm,
their current growth on middle single digit growth moving forward. So what you are paying for is the true safety of these household essential products of these are products that people are basically unwilling to go out with. And
mhm.
Colgate Palmolive is one of the most well recognized brands you can possibly have in this space. So you're paying a premium for their positioning.
So minus that PE, they probably look pretty good, but when it's overvalued like that, it gives you caution.
That's it. So am I willing to pay a 35, 34x on a company that's basically projected to not grow? I mean, I could that's more expensive than tech companies on
Right.
there. And so again, I have to really know that I am buying this stock because it is so well positioned with such a strong brand. And that's the choice you have to make with this one.
Yeah, and then that's where maybe your research would come in to see what protective moats do they have? Do they have a lot of market share? What other rationales could you see that you may, you know, do indeed decide to invest in? But that's where all that research we talk about early in our season one comes to play, right?
That's right, exactly. So
Yeah.
this is a key thing of if the research that you come to concludes like, you know what, it is worth paying up for this one because it's so consistent. That's it makes total sense. And again,
Yeah.
you're not alone. With having a PE that high, people are willing to invest in that company.
Right. All right. What do you score it?
I give it B tier. So
Okay.
again, I love the brand, but I don't like the valuation. So that one kind of brings it down a little bit for me.
All right. So that's Colgate Palmolive. Next one is Procter and Gamble. Thoughts?
Yeah, P&G is one of the biggest companies on this list. I mean, they are valued at 350 billion. I mean, they own products across so many different household essential products. So they are truly like a household name on this list. Their dividend is just under 3%. It's been growing in like the middle single digits, and their growth moving forward is pretty limited as well, right around a 3%. But they traded at a more reasonable valuation. They're right down around 21. So this one I'm paying for a very premium brand and a very safe premium positioning at a pretty reasonable valuation.
Yeah, and their breadth of product and market probably helps bring some stability for them from a revenue front as well. And if obviously, the economy drops, people are struggling, they have products everyone needs, right?
Yes, I mean, if you were to pick one stock on this list that's like, what's the one that'll let me sleep the best at night? It's probably P&G just because they have the absolute best portfolio and positioning out of pretty much any company on this list.
All right. What do you score them?
I give them an A tier.
An
So
H.
again,
Okay.
if I want a true consumer staple, like the one that people would be like, what's the number one? It's probably P&G.
Okay. P&G. Next one is Walmart.
Everybody knows Walmart, that's for sure. And they also have an amazing business model, probably one of the best business models on this list, because not only do they have their core Walmart store, they also have Sam's Club. And the club model is starting to become more and more popular as people look for more ways to save money. So Walmart is positioned really well as just that true value retailer. Their dividend is definitely on the lower end for this list. It's at 0.8%. They've been growing it in the middle single digits, so like that's been nice to see. And they actually are projecting from an EPS growth in double digits as well, which I think
Well,
would be a little bit surprising for what you would see for a retailer. But after all this, you are paying a premium. I mean, they're trading at a 43 PE right now. I mean, they are the largest company on this list by a long shot. They're at 963 billion right now for a market cap. So they are a massive company that has pretty amazing positioning for both of their brands, and they're growing really well. So you're seeing all of that come together.
well, and when anyone's trying to cut costs, there's no bigger brand that people think of when they think of affordability and getting what you
Right.
need.
So with an inflation situation like we're dealing with right now, this is where people just flock to Walmart. And
Right.
that's why, like, not only do they have the low income consumer that's going to Walmart, but with the Sam's Club, I can start attracting a little bit more of an affluent shopper that is willing to spend more to get a better value. So it's like I'm winning on both sides of the fence with Walmart.
Well, and then they combined the whole grocery thing too with the store, which gives them even more opportunities.
That's a great point. And their mix of premium goods versus grocery is much better than Target. Like Target wishes they had the mix that Walmart does because Walmart acts much more like a consumer staple brand, where Target's kind of caught somewhere in between.
Well, then you you also add that they're an online retailer now trying to compete with Amazon, maybe not to the level of Amazon, but they definitely, they have the Walmart Plus subscription for deliveries and stuff. They're definitely trying to grow, if you will, as well.
Yeah, I think that they did such a good job of getting ahead of this e-com surge. And Walmart Plus, like you mentioned, is a fantastic model. I mean, if I'm signing up for Walmart Plus, I'm probably spending a lot of money online with Walmart. So they're getting a really heavy core consumer on there. And it's free money with that subscription. I mean, that is 100% profit when they get those
Mhm.
subscriptions. So those are all the positives that they have going for them.
All right, drum roll. What do you score Walmart?
Walmart is A tier for me.
Okay.
I think that they are such a household name with such consistent growth. And like we mentioned before, they are positioned very well for inflation environments and just moving forward.
Right. Great. Well, we got one more on the list, and curious your thoughts about Costco.
Perhaps saving the best for last in this
I was gonna say I
situation.
was getting nervous. We haven't had an S tier yet.
And I think we might be getting there, but
Okay.
Costco has the best business model out of anybody that we've talked through right now. They make so much money on their membership approach, and they have a smaller dividend. It's only zero point 0.5 versus a lot of these other ones, but they've been growing at double digits, which again is something that I really value. And their growth moving forward from an EPS perspective is also low double digits, which is really high for retail. Now, the con to this is you are paying up for this. Their price to earnings ratio is floating right around a 50. So I'm paying a premium for this. But when you think about the business model that they have, I think that that is worth paying for because it's so much money coming in versus what a lot of their competitors just don't have. This allows them to keep prices really low.
Yeah, they're interesting. I'm a fan of Costco. We shop there, um, but they have both groceries. affordable things and luxury things, but yet they've been able to transcend that mix, unlike Target. Thoughts there?
I think the membership model is the key differentiator there because you're right. They are known for like their huge TVs and they sell tires and they sell luxury goods like jewelry and computers. So they have a lot of really high-end things there. Now, granted, when you read some of the reports, they are getting impacted in those areas right now.
Mm.
So that really expensive consumer is pulling back a little bit in these higher areas. So that is kind of like I wouldn't call it a red flag, but it is a caution flag with Costco is that they do have that consumer that's in there, and those goods are not going to do as well when inflation is high.
That's a great point. All right, here we go. Final drum roll. What do you give Costco?
Costco is our S tier
Right.
stock on the list. They are my favorite of the list for consumer staple. They have that beautiful blend of double digit dividend growth on double digit stock growth. And I think that with the valuation that's up there, they're worth paying for because their model is so good.
When we did the dividend tier ranking, Costco came up as well. And you mentioned that sometimes they do special allocations, and I forgot to ask about that then. So tell me a little bit about what they do there, and is that scheduled? Is that just based on the board?
Yeah. So this is really important to note because this is not counted in that 0.5% that I
Mm,
mentioned before. They have been known to pay special one-time dividends. And these are significant dividends. I mean, they will pay like $15, $20 a share that you
mm,
own as a one-time payment. And this is basically just the board's way of rewarding shareholders. Like it's just the way that they've chosen to do it several times. And they make so much money that they just start sitting on a lot of cash and they feel the best way to do it is with these special one-time dividends from there.
mm,
So that's another bonus that you just don't know when that could happen. And when that comes out, Costco stock pops off.
mm.
Like those are the ones that people come running to the stock when they hear any rumors of those special dividends coming up.
Yeah, I could see why. I could see why. It's interesting because they do e-commerce a little bit, but my gripe is sometimes the price you see in warehouse is not the price you get on delivery or when you order it online. But they're also trying to spread their reach online as well.
They have a big presence online. It's Amazon, Walmart, and Costco as the three big online retailers, in my opinion.
All right, well, there's 15 consumer staple, consumer defensive stocks tier ranked. Any final thoughts, Alex?
Yeah, I think again with when these kind of stocks, if I'm early on, I may pick one from the list, and my personal favorite would be Costco. But do your own research and figure out which one you like the best. If I'm later on in my investing career and have more money built up, I would think about a couple of these names on the list because you will be really happy to own these, not only for their dividend, but when tech stocks or anything else pulls back, these stocks are way more stable so that you can sleep a lot better at night.
Yeah, the thing I'm thinking about, I want to run through by you is when there is a dip, um, looking at some of these top ones, A or S tier, and if it looks significant and a good opportunity, taking a position in one of those and kind of thinking about it similarly, like how I might look at like the S&P 500 ETF or something that can hold the line if general market's going bad or the economy's in a rut, just to get a little bit of stability in the portfolio.
Yeah, and I think if you see dips on a lot of these stocks that we talked through today, those are very rare
Mm.
that we see a significant dip. Like those 10-point dips you could see coming from a lot of tech stocks we talk about, those are very rare in these companies. So if you do see it, you need to research why it happened and then figure out if that is actually a good time to buy. Because if these things pull back 10%, that's usually a signal to buy because these things are usually way more stable.
Well, thanks for taking us through your tier ranking consumer defensive stocks. I encourage anyone who's listening or watching to like and subscribe so you can stay aware as we release these videos. Also, you can reach Alex at alextalkstocks.com, or obviously you can comment on the video below. But if you go to the website, you can also sign up for our newsletter that we're going to be releasing shortly. just a little extra nuggets and thoughts from Alex as it relates to the market and all things stocks and investing. So thanks for your time, Alex.
Yeah, it's been a great discussion. Looking forward to next time.
All right. Talk to you soon.
Till then.
Ciao.